All right, guys, welcome back. Coach Roel again. I was able to pin down our fearless leader and founder, Scott Meyers. How are you doing, Scott?
I'm doing fantastic, Roel. How about yourself?
Doing well, doing well. Thank you very much. So I know you're busy as always. So I just want to jump right on in.
Mhm.
And I've noticed some comments, and even myself as well, have been wondering. There seems to be an increase in activity by the REITs, the real estate investment trusts, and other larger players acquiring portfolios of storage
Mhm.
facilities, as well as I seem, maybe it's just me, but I seem to see an increased intention from mainstream media like the Wall Street Journal, New York Times, et cetera,
Mhm.
uh, on the attractiveness of the self-storage industry as an investment in general.
Mhm.
What would you say are some of the pros and cons of this increase in acquisition activity by bigger players and increased media attention? Is that good or bad for us?
Mhm. Well, I guess it could be a double-edged sword, and I have to be careful here because I write for Forbes magazine, and I'm always talking about how great the industry is. So, if there's anything negative, I created it, or at least I'm a contributor to it. But one of the good things is, at least for us, our business model is to buy existing facilities and create value in them, turn them around, raise rates, put in technology, build more buildings if we can, and then sell off to exit by selling off to a larger player. The larger players have more money. They usually pay a higher multiple. They can gain economies of scale a little bit faster by buying a facility or multiple facilities. And if they have the money to do so, then when they fold those into the mix, then they reduce a whole layer of management that they already have in place and marketing and, a back end platform. So the more facilities they can buy, the better for them. So is he increased attention, what pros and cons. So let's talk about the pros first, and it is just what I mentioned. Our larger projects where we are developing a facility from the ground up or converting an industrial building to self-storage, these 4 or 5 year projects. In order for us to exit, in order for us to do the projects, we have to syndicate. We bring in our equity partners, and we offer them a certain projected return on these assets. And as long as we hit our marks and we sell when we say we're going to in a 4 or 5 year time frame and at the projected terminal value, that's how we then reverse engineer their returns to them, and they get their IRR, their internal rate of return. So, we give them they invest 50,000 with us, and we give them their 50,000 back in 5 years plus a return on top of that. And so as long as we can do that over and over again successfully by exiting to these REITs, that's how we're able to continue to grow and continue to have more money to invest in the next project. So the more of the larger players that we have, and now even larger players aren't just the large REITs, the real estate investment trusts. I mean, we have a whole lot of folks that are coming in now and creating these mid-level REITs. They're hedge funds and groups of private investors, funds that have been created just to acquire self-storage facilities, and then they either have the management in place or they figure it out by third party. So the more we have of the bigger players that are looking to get into the space, creating more of a competitive environment, the higher the valuations that we're going to get when we exit and when we're selling our facilities. So what does that look like on the front end? What are the cons? Is it increased competition now that all eyeballs are on self-storage, as you mentioned? People are pulling away from Wall Street. This ebbs and flows, and we see the money leaving Wall Street because it is vapor. It's just paper. And they don't know who the manager is. They don't know who's making policy or what the next policy is, or how their investment's going to be affected. And Wall Street is very, very fickle. And so, while their investments are going up and down, like a pinball machine, many of those folks are exiting and they're looking to invest in a hard asset that produces income and a return. So, real estate, it's bricks and mortar. They can see it, they can touch it, they can feel it. They have an understanding of who the manager is, or the company, what their track record is, and how well they have been performing. And at the end of the day, they know that they're not going to lose 100% of their investment, or a significant amount, because they still have the real estate. Even if the operations and the cash flow isn't as great as projected, they've got the asset that can be sold off, and that's how they make their money as well. So the folks that are looking to get into the game on an active basis, is it more competitive? Well, there's lots of money chasing it, but not all of those folks are looking to do it actively. So for the smaller investor, we go back to what I first mentioned, and our business model from the beginning is to find these value add facilities, create that value, and then sell it, trade in and trade up. And so the more people there are that are looking at these, even though there are more, there's fewer and fewer people that are willing to actually do the heavy lifting. So, our business model from the beginning is to provide that. That's what we do. Our specialty is finding the value add assets, creating the value in it, and then selling it off to somebody else who wants a fully functioning turnkey self-storage facility that already has the best business practices and standard operating procedures in place. So there are folks that are looking to get into it that are a little bit new and green, and they're not familiar with the underwriting of self-storage. And so from that stance, they may be driving some of the prices up because they don't know any better. However, for all of those folks, there's plenty of folks out there that are still selling, and there's a whole lot of facilities to be able to go around. And I believe that there's fewer people that are actually willing to do the heavy lifting on the front end, which is what we do. And so we think that there's a greater opportunity for those of us that are actively in the business right now.
I read in one of the articles, I think it was the one that I know you like to show in some of your slideshow presentations. There's the two in particular that, what are the cool kids doing, where you have
Yeah.
a picture of an article where Warren Buffett is
Mhm.
getting into the game, or
Mhm.
to the game, it sounds so casual, but getting into self-storage industry, and then
Mhm.
also Bill Gates. I
Mhm.
believe there was a quote by one of their senior executives saying that what they're looking for are facilities that have a minimum of 25,000 square feet,
Mhm. Mhm.
or
Mhm.
multi-property portfolios, even
Mhm.
multi-state portfolios.
Yep.
So first off, for the uninitiated, around how many units would you say is 25,000 net rentable square feet? And is that are those criteria reasonable for someone just getting in thinking, oh, I'm going to get in and buy a 25,000 rentable square
Mhm.
foot facility, and then in 5 years turn it around and sell it off to Bill Gates?
Well, first of all, I think you try to buy the biggest that you possibly can, period.
Okay.
Because it's much easier to buy, believe it or not, a larger facility. And I think some of those folks out there may have heard this before, and they may think it's hogwash. But when you're going to the bank for money to borrow money for a facility, the greatest thing that they can see is that it is sizable enough, it's large enough, you get economies of scale enough that you can hire a property manager or property management company, a professional company that's going to manage it. And the further you get away from 25,000 square feet in the other direction, meaning 10,000, 15,000,
Mm-hmm.
you won't find a company that will manage that. It's too difficult, and the economies of scale doesn't kick in until you get up above that threshold. So 25,000 square feet, we're looking at 200 units, give or take, depending upon the size and the unit mix. Could be 150, could be 250. Just really depends. But at the end of the day, a 25,000 square foot facility is usually generating enough income that it can support in the standard underwriting principle of 5% of revenue for a management company. At 25,000 square feet, these management companies, the minimum that they will take is either 5% or 2,000 roughly a month, or $2,500 a month. And anything smaller than 25,000 square foot usually doesn't meet that. So again, I'm guessing, but that's pretty much standard in our industry, that when you get below 25,000, you're going to have a hard time getting a management company to put it in, to manage these facilities. So for them to say a single asset entity that is 25,000 square foot on up to buying multiple facilities, I'm betting that those multiple facilities are also all above 25,000 square foot. And really the institutional players and the REITs, and when we're developing or converting a facility, our minimum is we have to end up with 55,000 net rentable, or most of the REITs won't touch it. They're not interested in it because they can't get that economies of scale and the returns they're looking for making some of those incremental changes that they can do at the management level.
Mm-hmm. Now, Greg Michael has a great presentation I've seen him do once, where he
Mhm.
says, I believe, correct me if I'm wrong, it's titled "Big Money in Small Facilities."
Yeah, that's it.
And is that still, is it equivalent? Like, say, for example, two smaller facilities at 15,000 square feet each. Would that be equivalent to one $30,000 or 30,000 square foot facility in terms
Well,
of the attractiveness of exiting and selling to a larger player?
yeah, it's going to be less attractive. And so, of course, Roel, you know the answer, and the answer is it depends. And it depends on a lot of things, and it's mostly the proximity. So if you've got two 15,000 square foot facilities, neither one of those can afford to support a part-time manager that's sitting at a desk. But could they both collectively do that? Yes. So that means that they really need to be in the same market. They need to be somewhat close to each other, so that, some appointments are set up, or excuse me, some sales appointments are set up by meeting in person at one office. And so what Greg has built, and what many of our students learn how to do, because we teach them, is the hub and spoke method, where Maybe you have one facility that is 20, 25,000 square foot that has a manager that is in the office. And then there's other satellite or what we call annexed sites that are an eighth of a mile down the road, 2 miles down the road. And the appointment and the sales meeting occurs and the rental occurs in that office that is at the headquarters, if you will, at the hub of these facilities. So Greg has done a fantastic job at this. Many of our other students, we've taught them and shown them how to do this and how to utilize the proper technology from entry into the facility, entry into their unit, and then from a management standpoint and a website standpoint, we can do a lot of the heavy lifting through our website and the technology that's available at the site level, so that we don't have to have people physically at a location to rent units and manage the business.
Mm-hmm. Mm-hmm. You mentioned something that I kind of connect the dots as we just did at the time of this recording. We just did a virtual self-storage
Hmm.
academy, and a
Hmm.
question came up with which was, if I remember correctly, what would be the minimum size capital raise, or is there a minimum size capital raise to before one starts thinking about raising capital from other people,
Hmm.
and then also with how does that sort of tie into having is it realistic to have a number of small facilities and bundle those together, like I said,
Hmm.
a number, like if it was exactly like what you said, a hub and spoke method where you
Hmm.
have a say 4 or 5 that are around the 25,000 or less range.
Hmm.
I know that's kind of a two-part question there, but
Hmm.
first of all, what would be the I say is there a minimum size for a capital raise to target that, and then how realistic would it be to get a bunch of those together and sell them
Hmm.
off?
Sure. So, there's a cost involved in raising capital. And when you talk about minimum in terms of dollars, first of all, the SEC, the Securities and Exchange Commission, states that if two or more people are coming together in an entity and one person is bringing the money and that person that's bringing the money is taking a passive role, they're not involved in the decision-making process, then you have a security. You've created a security.
Mm-hmm.
If two partners are bringing capital to the table, or even if one of them is, but they're actively involved in the business and they're at the general partner level, then you may not have to go out and create a security. But then when you have three people, one person's probably going to be passive or not making a lot of decisions. And so at that point, you're looking at facing anywhere from 10,000 to upwards of $20,000 just to do the legal and all the work and the heavy lifting that goes into creating a syndication, a private placement, and register it with the SEC. So part of that factors into it. And when we do these, unless you're going to do a blind pool or a fund where you're going to be putting multiple facilities in on a regular basis, then and have a high cost, usually these are single asset, single entities. You raise the money, you close on the deal, and the PPM, the private placement, is closed out. So it's memorialized, and here are the investors. They put in this amount of money, and they're in there until they either sell their shares or we sell the property. So it's a little more difficult than to gather more facilities in an area and then be able to sell it off at the end. It can be done. It's just a little more difficult to be able to do so. So now, could you go out and buy some of these and do it with your own money or some partner's money, and then eventually go out and recapitalize by syndicating and bringing in private capital to take a piece of this? And as long as there's upside and returns in it for them to do so, absolutely. There's many folks that do that. They keep the properties, they just recapitalize and take out the other money that was in it to begin with, that got the facilities off the ground and stabilized to begin with. So a number of ways that you can raise capital, but again, I'll go back to the more and the larger the facilities, the easier it is to be able to get funds from the bank, from private equity partners, and to then exit and get the money from the real estate investment trusts or the larger national players or regional players that are looking to buy your portfolio from you.
Mm-hmm. Now, I guess one of the last questions, if not the last question I want to pose to you is is there sort of an ideal business model that you would promote on the education side, or a path that a student could take? Let's say they've got a little bit of residential real estate experience,
Hmm.
but getting into this in commercial, you and I know it's a whole other animal.
Hmm.
What would you say would be, I know there's many different paths that one could take,
Hmm.
but something that someone who's watching this for the first time and just looking at self-storage very early on, what would be a good placeholder as to
Hmm.
a business model and a path for them to get in, do well, possibly turn something around, and then exit in, say, 5 to 7 years?
Yeah, I think that's just it. It's getting into, if you're going to get into the business, new to the business, it's buying an existing facility, because then again, when you walk into the bank, it's a whole different story when you've got a facility that has been operating for the past 10 years, and they can see the historical track record of it, occupancy, the net operating income year after year after year, and you can talk you bring a good solid business plan and talk about your strategy and how you're going to take it from here to here, and show them the path to profitability and when you're going to exit. That's much different than the first time self-storage investor coming into the bank and say, hey, I've got a piece of dirt over here and I'm going to build a self-storage facility on it. Then I'm going to put an income stream on it and I'm going to sell at this price. And they say, well, do you have any experience in this? Have you done this before? And you say, no. That's a big risk for them, because again, the bank is also looking at long-term exit strategy and worst case scenario. Worst case scenario in development is that you fumble around and you mess it all up and you're still got a piece of dirt and they give you a whole bunch of money. Worst case scenario, if it's an existing facility and you fumble around and you mess everything up, they'll take the facility back, put a receiver in place, manage it for a while and then sell it off. So again, I'm getting to your answer, and that is, I feel that everybody should always start with an existing facility because it's an easier story to tell. It's an easier path for the bank. They're not taking as much of a chance on you as they are taking a chance on the property. And as long as the property looks solid, the numbers are good, and you know what you're doing in the underwriting, they're not taking a chance on the property. It's a solid deal. And that is something that they will fund. And your credit score and experience is secondary to the strength of the property.
Excellent. So that's great. I think we're a little bit over time on that one, but as always, it's been a pleasure tugging your ear. What's the term? Bending your ear and asking some of these questions to you, Scott. So what we'll do is we'll catch up again next time in a couple weeks.
Looking forward to it, Roel. Thanks so much. Appreciate it.
All right. Thanks. Take care, Scott.
All right. You too. Bye-bye.
Bye-bye. Thanks again for joining us here at Self-Storage Investing. We really, really appreciate it. For more great content like this, make sure to click the subscribe button below this video. And be sure to follow us on Facebook, Instagram, Twitter, LinkedIn, and BiggerPockets. You can also visit us at our main website at selfstorageinvesting.com, where you'll find even more free content, our ebook, and registration to our free webinars and education courses, and much, much more. Once again, for more great content like this, please click the subscribe button below. Thank you.